Hi everyone, this is Rohit from Lifestyle Mastery, and I'm excited to have Triin Linamagi, who's the founding partner at Sie Ventures, which is a trusted capital platform for female co-founded businesses and investors in Europe. Triin was a former entrepreneur turned investor with experience from the Venture Collective, Founders Factory, and Bootcamp. A big thanks to Anne Thoi Chong from Lago for the introduction. Welcome to the show, Triin.
Thank you so much for having me.
Awesome. So Trent, you do have a great journey. You've been, on the founding team of a lot of fintech companies, especially MyChor, Cash and Go, Jobber. You've been part of Startup Bootcamp and Founders Factory. What what? How did you start your journey in this crazy world of startups and venture capital?
Yeah, sure. So actually, I started my first company that I joined as a founding team member was back in 2009. Just after the recession, or almost kind of coming out of the recession, and it was actually a consumer credit company back at the days when FCA hadn't yet regulated the UK market for consumer lenders.
Right.
So I had an opportunity to build up two companies in consumer lending space. Had a lot of experience from there and a lot of learnings. And then after that, I felt that it's not quite the industry I want to stay involved for a long time because you're dealing with very vulnerable customers, and wanted to move away from that. And I set up a company in 2014 in London that is actually an HR tech company, and ran that for 3.5 years with my co-founder, and sold my shares back to my co-founder, and went into investment side. I was just always curious on how investors think about how to best convince them to back my company, and had my own lessons learned in my previous company as well, how hard it actually was. And yeah, I actually, my first role was at Startupbootcamp, and there we actually backed fintech companies, and also we were backed by corporates, mainly by banks and financial institutions. We had some great companies out of our programs. We had Rails Bank, we had Pentabank, some of the really good, well-known names, and a bunch of other great companies as well. And I then headed to Founders Factory's investment team, where I looked after investments on behalf of EasyJet, The Guardian, Aviva, and another PE fund actually from Asia. So my kind of coverage was very much across different sectors. So I looked at media tech companies, I looked at travel, aviation. I even did a due diligence on an airline company, believe me or not. And I looked a lot into insurtech, fintech, AI, and deep tech. And then actually, I was invited to join a new fund, the Venture Collective, that was just being set up in the US market. And it was a great opportunity to join and see the journey of building the fund from ground up. So I joined the fund, didn't stay for very long because I had a calling to really support female-led businesses, and I wanted to go back into building while also investing, but focusing particularly on the European market and UK market where my network is, and that what actually led me to build Sie Ventures.
So super interesting. And what would you believe would be your biggest takeaways from your time with Founders Factory and Startup Bootcamp, especially for listeners who would want to jump from an operator role to say an investor role?
Absolutely. I think, Founders Factory and Startup Bootcamp are very early stage investors. They're accelerators, right? So the models are very different. I would say that working in an accelerator investment team is incredibly intense. And, if you can handle that, it really prepares you well to move to larger VC firms, because you don't only diligence the companies, you do that as well, but you also have to, work with your corporate backers. You have to sell the value of the programs beyond just the money, and also find the fit between your corporate backers and the value you deliver to them, as well as to the companies, but also making sure that these businesses that you go into so early will become venture backable businesses, and they have what it takes to get to the next stage with the support of the operations within the programs, and the little capital that you're able to invest in them, and also that you can help to find follow-on investors for them, because you go in super early, right? You're going in almost that idea phase. So it was very, very intense. You know, I led ICs, I prepared for the ICs, found stakeholders from corporates to attend them, so the right people behind the table to make the decisions, as well as the management team of Founders Factory, and making sure really all the key decision makers are there. So it's quite intense, and then obviously you have to negotiate and close the deal eventually as well. So it's almost like the full cycle of what you have 5-10 people in a fund normally, you'll do it just by yourself alone. So it's definitely a great learning curve. That was one learning, but the other one I would say is that accelerator models are just very hard to make it work. So if you look at traditional fund model, which is normally a 220 model, then with accelerators, you need to charge much high operational costs, management fees then, because you have high operational costs and you need resources to deliver the value to the companies. So 220 model doesn't really work for accelerators if you have a traditional accelerator model, unless you have it as a sidecar fund. So also when you look at from founders' perspective, you constantly need to prove the value, but a lot of the value doesn't come in cash. It comes with the resources that you provide them, the support, the people behind it, and you know, that should then justify the equity. But it does really require good people, knowledgeable people to build these strong teams and run these accelerators. And I think that's why, you know, we have good accelerators, we have bad accelerators, medium accelerators, and we have very different opinions about accelerators. But yeah, it's definitely a great experience before I stepped into fund structures and understanding how traditional venture funds work.
Interesting, and you know, I agree that it's not only the money; it's the resources and the advice, which is so valuable for founders. And you know, before you stepped into the VC world, what is the thing, you know, especially for listeners who want to be who are budding venture capitalists? What is the one thing you wish you had known before you started your journey in venture capital?
Yeah, I think there are quite a few things. I think one thing is, I think what I didn't think about is really understanding how venture capitalists really work, how the models really work, the fund model and the economics behind it, and you know, understanding how much money you need to raise and multiple times in order to actually make the economics work, and also that venture capital world historically, and it still is, it's made to make wealthy people more wealthier. It is very hard to make it work if you don't come from wealth, because it's so network driven, particularly the fundraising process itself. And the other thing actually that I would say, and that is more, you know, not just from a fund management perspective, but if you want to go and work in a VC, or be a VC, you know, associate, analyst, principal, partner, you know, however your career progresses, the management of your time, how you constantly pulled in different directions, and you need to start saying so many no's that you just, you know, never thought you would have to do that. And it's almost impossible to please everyone, because it's just very easy to lose yourself in this world and forget that you have life outside of that. And it almost becomes your identity. And you want to help so many people, but it's just, you know, as much of you out there, and you have to prioritize. You need to prioritize your time a lot. And I think managing and prioritizing your time will become the key skill set that anyone would need in this industry.
Interesting. You made an interesting point that you know, you need to come from either for wealth or have a big network. But what if, you know, somebody doesn't have that wealth or the power or the family? Can somebody, you know, from scratch build a network and, you know, do well in venture capital?
I think you can, yes. I mean, you have to hustle a lot, you know. I mean, if you look at some venture capitalists, you look at Harry Stebbings, for example, right? Yeah. I mean, you know, he's built his firm based on his podcasts and what he did with entrepreneurs and venture capitalists before, and really learning throughout that journey, right? So I think there are different ways to approach it, to be honest. building your network from scratch is very hard. It requires the same hustle it requires as you building a startup, but the sell is even harder because you're not just selling a product. You're selling that they have to take a bet on you and trust you with the money. And it's not just $1 million or 500K. It's, it's hundreds of millions, or maybe even starting off from 30 to 50 million. So it's the trust that isn't quite there yet, and it takes time to be built. So I would advise anyone who's starting it just to start with this relationship building journey very early on, and start with high net worth, start with family offices, start building these relationships, start sharing deal flow, and there from onwards, start building relationships with institutionals, because it takes the longest for them to actually get to know you and understand if you have what it takes to actually build a fund.
That makes sense. And you started Sie Ventures where the goal is to close the gender funding gap, where you're helping our female founders, and you built a Sie Catalyst and Founders program, which is supporting founders. So how are you helping female founders in their journey?
Yeah, so when we usually bring in 10 founders per program, and we set it up as a program because otherwise it's just really hard to manage it. So we select usually 10 companies out of 200 during 6-week process of sourcing. That was the latest stats we had. And when we bring them in, we actually open up our networks of VCs, angels, bring them through the program through different sessions, like one-to-one sessions we organize, office hours. We give every founder actually a mentor among VC. So what we're trying to do, we're trying to almost make venture capital more transparent and transfer all the knowledge to founders before they go and start raising these venture capital rounds. So they understand how VCs think and why they think so, and how they can really adjust their pitch, adjust their vision accordingly, and understand why it's so different to raise money from VCs versus angels or bootstrapping it, and what is required for the business to actually raise capital from VC funds and what the expectations are. And then we have different sessions, from fundraising, one-on-ones to financial modeling, storytelling, pitch decks, but really about what VCs want to see. We bring in Sequoia, we bring in Stride VC, we bring in other great funds who talk from their perspectives of what they want to see. And obviously these mentors who are then involved, hopefully these organically convert into checks at some point, because this relationship is built in time. We actually have seen 40 checks last year from our investor community, and we had 25 companies, and these 25 companies actually ended up raising about 28-30 million. It might seem a little, but if you think it's just 1.5 years and they're all pre-seed seed companies raising average 1.5 million rounds, then it was actually really impressive to see that. Interesting.
And a company can never build defensibility on day one, but what are your thoughts on how can a company build defensibility over time in a specific sector?
Yeah, absolutely. I think it's really kind of well known that obviously technology is your defensibility, right? But I think today your moat can be also community, building a strong ecosystem or community of customers, these loyal people who are in your community and will bring in new members is almost free marketing, right? So if you can build a sticky community and engaged community, then I think you're lowering your customer acquisition cost already very early, and you just need to prove out the consistency there. And also I think the strong brand positioning that is constant, and finding a strategy how to be heard and seen. I think it's really important and gives the edge to a lot of companies who might not have the tech defensibility. So we've looked at companies and we've invested in companies that perhaps doesn't have the strongest tech defensibility, but have the community and the brand positioning that is completely right. So yeah, that's just some of my thoughts.
Got it. And how do you analyze the the venture growth market, especially in the UK and Europe?
That's a good question. Actually, it's something that it depends. I think what you want to get out of me on this one. But I think mostly what we see is that founders need to listen more to the customers and absorb the competitors, as well as the trends within their market. And if we look at UK and Europe, for example, oftentimes when founders want to expand from UK to the rest of the Europe, they don't take into consideration the constraints around language barriers, cultural barriers, regulations. And these are the things that, oftentimes founders haven't thought through when they put that on the deck, for example. And the other thing is what we always want to see is, is there an opportunity to expand beyond Europe and UK? Is there an opportunity to expand to US? How many players are there already? Or if there are strong players in the US market and they are actually tackling with that problem in Europe and UK, then can this be replicated here? And really comparing these. Oftentimes we've even spoken to US investors who invested in similar space, and just to understand what are the reasons they never expanded to European market, for example, if they have a company in their portfolio and so on.
Got it. And if you look at companies like Uber and Airbnb, they in the initial days, invested in the thought that they would have a big market size, but obviously they went on to become decacons and some really big companies. But how do you look at market sizing, and how do you assess market timing risk?
Yeah, it's a really good question, particularly around market timing. Because how we look at market timing actually is how we think about it. And when we look at companies, we think about it every time. Could have this company existed 5 years ago? And if so, is it really a reason why they're building it today? And probably there are competitors out there who are already doing this. And the other thing we think about often is, is the market ready for that? We think about it a little bit less, but we want to see enough validation in terms of, okay, show me that the market is ready, there is a demand. But why I'm saying I'm thinking about this a little bit less is because I think if it could have existed before, it's an automated pass for me personally. I wouldn't look at a business that isn't innovating, looking into the future. But a great story, actually. When I launched my previous business, we actually went to the market 2 years too early, and I really lived that through. And the HR, the recruitment sector we were selling to, they definitely weren't ready for the technology that we had built. So 2 years later, I felt they were ready. Now in pandemic, they were definitely ready. So these economical, political situations also really kind of drive that thought process. And also, like, we look at how many competitors there are already on the market. In a way, seeing a few competitors is good signaling, right? If it's too competitive and there's no differential advantage, we would really struggle. In terms of how we assess the market sizing is really about, do they actually understand how big the problem is that they're solving? And what we look at it more from a practical perspective as well. We want to see founders, because they're pre-seed stage, to show that they've really gone out there and done the market research, spoken to their customers, maybe gotten some of them to sign up, 500 to 1,000 free signups maybe in the wait list, before they actually go and start generating revenues or launch the product. This is what we would want to see, that there's this homework done in a more practical way, rather than just putting a TAM and SAM on the market slide, right?
Interesting. And what do you think would be your biggest miss when it comes to sorry, your biggest hit when it comes to as an investor, and especially when you get a big hit, does it really change your mindset on how you invest into startups?
Yeah, so I must say I've been investing not for a very long time personally with C and as an angel. So I would say that a biggest hit for me was our recent investment in Juno. We haven't seen an up round yet because we did that investment early this year. But when we diligenced the company and looked at the market, it really made us realize how big the gap in the market is, because Juno is actually an education and investment platform for women, and very much tackling with what Ellevest is doing in the US, but more from an educational perspective. And what we realized is, what we are trying to do here with C is also get more women to start investing, right, in our companies and in any companies out there. But in order to do that, we need to give women the tools and education in earlier age life cycle to understand how to even handle their finances better and start thinking about investing, when they're in their 20s, early 20s. So I think this is what has been missing in the market, and women invest very differently. And most women don't have anyone to turn to learn from or understand how to invest. And the traditional platforms out there are targeting white male customers. So it's not the same. And if you look at, where women go to learn about investments, they just go to the parents, they go to the boyfriends, they go to the family, and they manage the financials or advise them what to do. So we really invested in Juno to give women the power to start taking control of their financial decisions and think about investing early on in their life, and think about money and how they handle money very early on in their life.
Got it. And
I really hope it's going to be a big hit.
I love the name Juno. Sounds interesting. I think it's, if I'm not wrong, Alexia runs
Juno.
Yeah. Interesting. And who do you think, what would be your biggest miss when it comes to investing? You obviously have a lot of stories where you missed on investing something, but does it also affect your investment thesis when you missed out a big miss?
Yeah, I can tell you a story of a big miss, but it wasn't an investment. It was an investment of my time. So it was back in 2012 or 13, something like that. And I was offered a job at TransferWise, now Wise, as the second employee, maybe second or third, very, very early days. They hadn't even raised from P2C at the time yet. So it was just Christian Tavet, a couple of other people, and the devs in Ukraine, I think. And I was offered a role. We had 2 months of conversations, I think. And guess what? I decided to turn it down. And I still think about it. And 6 months later, well, obviously, I saw the investment going in. Some of my friends went to work there. And I was thinking back, I was like, wow, this was not right, is it? and now I think back at it and was like, we all make these decisions at some point in our lives. And it really has, like, in a way, like, today I'm investing in startups, and I'm thinking back at this and thinking, how can you make sure that this is the one that takes off? Because at that time, I really wasn't sure. I had so many questions, particularly knowing the UK market fairly well. We were based in Estonia. I'm Estonian, and yeah, I had a lot of doubts. But I think how it affects me today and my investment decisions is market research, validation, much more kind of diligence. This is something we do a lot, even for very small checks that we do at C. We do a lot of diligence actually for that amount of money. And I think you can write off a few risks with that, and at the same time, you never know, right? It's I think what is it, 80-20, 99-1.
Hey, interesting. And it's your perspective as an operator, but obviously you maybe knew the founder or the founding team, and they wanted to have you on board. But do you think listeners who would want to get onto a rocket ship, should they also look at at a thesis where they're looking at the founder and the founding team and the impact they can make, because it's so early in the game that they don't know where it's going to go. But do you think it's more about the founder and the founding team
Absolutely.
taking?
Absolutely, and it's the same way we actually validate the companies at so early stages. We're looking at the team, we look at the market, we look at the product, but the products will change, they will pivot, but the people don't change. And the same way when people are looking at joining startups, I think what you can do is vet the teams, the same as investors would vet the team first at that early stage. And particularly the expertise of the people, the founders, their experience within the sector, they like how technical they are, do they have the tech capability, their ambitions, their vision for the company, and really how they bring you along the journey with their vision as well. But very much coming down to the experience of the founders eventually.
It makes sense. And I want to talk about Sie Ventures. What is the portfolio construction? How do you look at diversifying your portfolio?
Sure. So we actually have built our portfolio construction model in a way that we would deploy about 30 tickets over the next 2 years and dedicate about 30% on follow-ons. And as a small fund for a 10 million fund, that it doesn't really give you much room for follow-ons, but I would say that 10 million is the minimum fund size where you can start doing follow-ons. Otherwise, we are telling today to our founders which funds can actually follow on potentially based on the fund size and why they need to ask funds how big the funds are and if they can do follow-ons. But in terms of going back to our thesis and construction is we're looking across 4 key sectors actually. We're looking at healthcare, fintech, future work and sustainability. And our primary focus is actually in the UK market, about 70%, and the rest of the 30s in rest of the Europe. And, as every fund, we have modeled in some write-offs as well, and some bigger bets, some smaller bets, but probably wouldn't go into too much detail at the moment.
Got it. And I want to understand, can you increase the ownership, especially as a small fund, can you increase the ownership into your best companies, since you're also looking at following up on your investments, at least, I would say around 20%? Is that something which is possible?
Yeah, absolutely. That's what I'm saying. Like, I think you need to look at least minimum 10 million fund, but I would even say that it's too small. Like 20 million fund starts giving you more flexibility of doing follow-ons in about 30% of usually the standard is 30-40% of the companies. And we follow that standard as well with our small fund. Eventually, otherwise, you're just going to be diluted out because, investing in pre-seed and seed, you're left almost with nothing if you don't do follow-ons in some of the best companies.
Got it. And do you also have the similar thesis when you're looking at capital concentration on a certain industry? Like, do you look at 30% of your funds getting into sustainability versus fintech?
I would say it's quite equal, actually. We do probably have a little bit more focus on fintech because this is where our backgrounds are, and we probably also have more concentration around B2B rather than B2C when we look at the sectors. So yeah, I would say there would be more around fintech and B2B.
Got it. And you've been a successful operator, and now you VC. How can the VC ecosystem have more founders and investors, especially women founders and investors? Especially since 7 million just found out that only 2% of the money gets into female founders, and that's a really bad metric. But how do you think it's going to improve over the years, and what should be the thesis for female founders?
Absolutely. I think there's so many ways to look at it, right? I think what we are trying to do right now, and one way to look at it is give women who are open to start doing angel investing an opportunity to actually put in small tickets into the rounds that they normally wouldn't get access to. At Sea, we realize that this is what we can do when we actually are helping founders first to find a lead investor, and then we go in with a smaller check. But these smaller checks that we put together at the moment for our SPVs, many of these investors are actually small ticket angel investors who come into these deals, and they wouldn't be able to get on these larger cap tables of 7 million, 5 million rounds with 5 to 10K checks. And we're trying to give these female angels the opportunity to almost get access to these venture backer rounds through us. So they get part of these big deals. It's almost like democratizing the access to venture capital for small angel investors. And nowadays, syndications and SPVs will allow to do that. And I think the more women we get to invest, the more capital we drive faster to female founders. But I think we obviously need a systematic change in the whole industry. We need to look at the VC industry as a whole, the processes in venture capital, the way, the biases in the venture capital, the way we question the founders, the way we diligence the companies, and where our referrals come from, particularly considering that today still majority of the funds are led by male GPs. So where do their deal flow come from? Where does their deal flow comes from, right? And I think for that you need also more women VCs. You need more women decision makers in funds and in higher positions, so they can participate the ICs. They have the votes. They can take the calls, and they can drive these investments in order to actually make a difference. And oftentimes it also comes to what the industries that women understand better, where there are massive gaps in the market, and male investors maybe just don't understand these markets well enough, don't have networks within these markets. So I think there's a lot to be done, and obviously we can just overall make the whole venture capital industry a bit more transparent for founders, and support them understanding how VCs think, and especially for female founders. And that's why we put together the program as well, because the industry itself, it works in silos, and it's almost like a closed circle that isn't accessible for anyone who isn't close to this circle. So we're trying to really kind of open up and bring in VCs who are really open and transparent and helpful with the founders, navigating through their fundraising journey and prepare them for it. So I think that's like something we can definitely start from already. And yeah, like not depending even on gender, but everyone to look at sectors where women are innovating and just doing a little bit more work to reach the businesses that are founded by women. So I think that is very important, and also understand that we're not doing that only for the impact, but if you're investing in businesses that at least has one female founder alongside with a male co-founder, you're backing the diversity, and your returns will be better. And actually at Sie as well, we don't only back female-only teams. We are fully backing male-female mixed teams, because we truly believe that diverse founders perform better, and there's proof out there about that already. So I think funds just need to do more work to reach these networks and dig deeper.
Yeah, no, absolutely, really, really well put through. And Triin, I quickly want to do the top 3. What's your favorite business book?
So actually, I had a favorite business book when I started a startup, and that was Guy Kawasaki's The Art of Start. And I remember that so clearly because I was reading that book, and it was so exciting, and I just still remember it. There's so many other startup books on how to start, but I still clearly remember it was really, really well written, and I think the advice, I'm still thinking about the advice today when I'm still operating and building a business alongside building a fund. It really was practical and useful. But recently, I actually read a book called 4,000 Weeks, and it actually makes you think that you have 4,000 weeks in your life, which seems really little, right? And it makes you really think about the time and puts time in perspective, how we think about the time and use it effectively. And I think anyone who is in venture capital needs to do that. So yeah, it was a great one.
Yeah, no, absolutely. We'll put that in the show notes. And Guy Kawasaki was a past guest on the show, and I think I loved reading his last book, which is Wise Guy.
Oh, that's great.
Yeah,
I'd love to meet him one day. I still haven't.
yeah, he's very approachable. I think he's very kind to come on the pod. We'll put that on the show notes. And if you could go back in time when you started Sie Ventures, what is the one thing you would have focused on or done anything differently?
It's a great question, and what, I've actually thought about myself a lot recently. And one thing I would have done, which I think I shouldn't have, is I focused too much attention on building a fund from day one. Whilst I learned very quickly that you first need to build up your thesis, your track record, and almost understand where your strengths are. And also wasting too much time on taking calls with institutional investors and vetting them, understanding what they want. It has been useful. I don't regret it. But there was also a lot of time and stressful moments that I could have avoided if I maybe knew a bit more, structured it a bit better, maybe had more experience, but these things come with an experience. So for any new fund managers, emerging fund managers, I would say really think that through and think a lot about your differentiation first and how you can build out this differentiation and showing it in a more practical way rather than just talking theory. Today, when I look at our work 1.5 years in, I'm so confident about our traction and what we can show to investors rather than just talk theory. So yeah, that's what I've thought about.
Yeah, no, absolutely. That's a great advice. And what's your favorite online tools? Example: Gmail, Slack, Zoom.
Good question. I'm really simple when it comes to online tools. Can you imagine? I still don't use Superhuman. Everyone is using it from VC industry, at least. But I would say like Gmail is my world still. But Monday is a great tool. We use Monday for a lot of things today when we still don't have funds to invest in a very good like CRM for deal tracking or monitoring. So we use Monday for that, but we also use Monday for structuring our tasks, our days, our priorities, but also like building our lists. So yeah, it's been great, to be honest. We need to grow out of it at some point, but it does the thing for now.
Yeah, no, absolutely. We'll put that in the show notes. And Triin, what is the best way people can reach out to you and know more about Sie Ventures?
I think my LinkedIn would be the best to reach out to me, and then I can come back to you with my email if we could continue our conversations.
Got it. We'll put that in the show notes. And Triin, thank you so much for taking our time and speaking to us. I really enjoyed my conversation with you.
Thank you for having me, Rohit.